In the early 1700s, an entire nation believed it had discovered the secret to unlimited wealth. People sold homes, emptied savings, and borrowed money just to buy a piece of a company that promised riches beyond imagination. At its peak, this company became the most valuable enterprise in the world. Its founder was hailed as a financial genius, a visionary who had cracked the code of money itself. Then, almost overnight, everything collapsed. Fortunes disappeared. Investors panicked. The economy spiraled into chaos. And the man responsible vanished into exile. The mystery is this: how did one of the most celebrated financial masterminds in history accidentally create the world's first modern stock market bubble? And why do investors continue to fall into the exact same trap today? To understand this story, we have to travel back to France in the year 1716. At the time, the French economy was in ruins. Years of expensive wars had left the government drowning in debt. The royal treasury was nearly empty. Taxes were crushing ordinary citizens, and the country's currency, heavy silver coins, was constantly in short supply. Trade slowed, businesses struggled, the economy stagnated. France desperately needed a financial miracle. That miracle appeared in the form of a tall, charismatic Scottish gambler named John Law. Law was not a traditional banker. He was a mathematician, a gambler, and a radical thinker who believed he understood money better than anyone else in Europe. His idea sounded almost magical. What if money didn't need to be made from gold or silver at all? What if governments could create paper money, backed by confidence, instead of metal? In 1716, Law convinced the French government to let him open a new kind of bank. It would issue paper banknotes. At first, the idea seemed risky. But something remarkable happened. The paper money worked. Businesses suddenly had more cash to operate. Trade increased. The economy began to grow again. To many people, John Law looked like the man who had saved France. But Law had an even bigger plan. A plan that would trigger one of the most dramatic financial bubbles in history. In 1717, John Law launched a company that promised access to unimaginable wealth. It was called the Mississippi Company. On paper, the company owned the rights to develop France's massive North American territory known as Louisiana. The region stretched across thousands of miles along the Mississippi River. Investors were told it contained endless resources: gold, silver, fertile farmland, fur trade riches, entire cities waiting to be built. To the public, Louisiana sounded like a financial paradise, and the Mississippi Company was the only gateway to that fortune. Law began selling shares of the company to the public. Demand exploded. But here was the brilliant and dangerous part of Law's system. Investors could buy Mississippi Company shares using the new paper money printed by Law's bank. As more shares were purchased, Law printed more money to finance them. The system fed itself. More money meant more investment. More investment drove the share price higher, and rising prices attracted even more investors. Within months, Paris was gripped by speculation mania. Merchants abandoned their shops to trade shares. Servants became investors. Nobles rushed to buy stock. People crowded the streets outside the company's offices just for a chance to purchase shares. The price of Mississippi Company stock began to skyrocket. In 1719, shares were selling for around 500 livres. Within a year, they exploded to over 10,000 livres. Some investors became rich almost overnight. Stories spread of ordinary citizens suddenly becoming millionaires. Paris transformed into the financial capital of Europe. John Law became the most powerful financial figure in the country. Eventually, the French government gave him control of the entire national financial system. He became the nation's finance minister. At that moment, it seemed like his financial revolution had succeeded beyond anyone's imagination. But underneath the excitement, a dangerous imbalance was growing. because the wealth people believed they were seeing wasn't entirely real. The Mississippi Company's stock price was rising for one simple reason. Not because the company was producing incredible profits, but because more and more money was being printed to buy its shares. In modern financial terms, this was the perfect example of an asset bubble. An asset bubble occurs when the price of something rises far beyond its true value, simply because people believe it will keep rising. And that's exactly what was happening in Paris. The Mississippi Company's profits from Louisiana were tiny compared to the massive valuations investors were paying, but nobody cared. As long as the stock price kept rising, everyone believed they were getting richer. This is where another powerful financial force came into play. Leverage. Many investors began borrowing money to buy even more shares. If the price kept rising, they could make fortunes using borrowed funds. This strategy made the bubble grow even faster. But leverage also makes markets extremely fragile. Because if prices fall even slightly, borrowed investors are forced to sell. And when selling begins, panic spreads quickly. John Law's system had another weakness. The paper money he created was supposed to represent real wealth, but in reality, more and more currency was being printed without real economic production behind it. In modern terms, the system was suffering from a liquidity illusion. There appeared to be massive wealth in the economy, but most of it existed only on paper. Eventually, some investors began asking a simple question. If the Mississippi Company was worth so much, where was the gold and silver backing it? When a few wealthy investors tried converting their paper money back into precious metals, a problem appeared. There wasn't enough metal to cover the claims. Word began to spread. Confidence, the very thing holding the system together, started to crack. And once confidence disappears in financial markets, collapse usually follows. In early 1720, the panic began. Investors rushed to sell their Mississippi Company shares. The same crowd that had once fought to buy stock now scrambled to escape. Share prices began falling rapidly. Leverage turned small declines into massive losses. Borrowed investors were forced to liquidate their positions. Selling created more selling. And within months, the greatest financial boom in Europe had turned into a devastating crash. The Mississippi Company's stock price collapsed from over 10,000 livres to just a fraction of its former value. Fortunes vanished. Entire families lost their life savings. France's financial system fell into chaos. And the man who had built it all, John Law, was forced to flee the country in disgrace. He spent the rest of his life wandering Europe, nearly broke. But the most fascinating part of this story is not the crash itself, it's the pattern behind it. Because the Mississippi bubble revealed something fundamental about financial markets. Markets are not driven purely by numbers, they are driven by human psychology. Hope, greed, fear. Every major bubble in history follows the same cycle. Excitement creates rising prices. Rising prices create confidence. Confidence attracts more investors. Eventually, speculation replaces reality, and when confidence breaks, the entire structure collapses. We've seen this pattern again and again. The stock market crash of 1929, the dot-com bubble of 2000, the housing crisis of 2008. Even modern cryptocurrency booms have shown similar patterns. Different assets, different technology, but the same human psychology. Which raises an uncomfortable question. If you had been living in Paris in 1719, watching everyone around you become rich, would you have recognized the bubble? Or would you have joined the crowd?